Two men, one table. One sees possibility in every investment, the other sees disaster waiting to happen. One believes in the goodness of management. The other assumes everyone is lying until proven otherwise. One thinks markets are efficient enough to trust. The other thinks markets are often irrational at the worst possible times. Same data, opposite conclusions. Yet together, they built the greatest investing record in history. Here's what doesn't make sense. Optimists and pessimists shouldn't work together. Believers and skeptics should destroy partnerships. Opposite temperaments create friction, not fortune. And yet Warren Buffett and Charlie Munger prove the opposite. For over 60 years, these two fundamentally different minds sat in the same room, looked at the same opportunities, and came to different conclusions thousands of times. And that difference didn't weaken them, it made them. Because here's the brutal truth most people miss. The greatest danger in investing isn't being wrong, it's being right for the wrong reasons. And you can't see your blind spots when everyone agrees with you. Buffett needed someone who saw what he couldn't. Munger needed someone who believed when he wouldn't. One provided the courage to act, the other provided the discipline to wait. Together, they created something neither could achieve alone: perfect calibration between action and restraint. This isn't a story about compromise. This is a story about complementary forces creating something greater than their sum. The math is simple. One mind alone sees half the picture. Two opposite minds together see the whole game. Warren Buffett wakes up every morning believing good things will happen. Not because he's naive, but because optimism is a strategic advantage in capital allocation. Here's why Buffett's optimism works. First, optimists see opportunities that pessimists miss. When everyone is fearful, the optimist is buying. When markets crash, the optimist sees sales. Second, optimists attract better deals. People want to work with someone who believes in them. CEOs call Buffett first because they know he'll see the potential in their business. Third, optimism compounds. Over decades, betting on human progress and American prosperity has been the winning strategy. Buffett's entire philosophy depends on believing tomorrow will be better than today. Fourth, optimism creates courage. You can't invest billions in a single company if you're constantly imagining disaster. Buffett's ability to go big when he believes comes from fundamental optimism. And this is critical, optimism has a fatal flaw. Optimists see what they want to see. They overestimate management competence. They underestimate what can go wrong. They fall in love with stories and ignore red flags. Buffett's early career was full of this. He believed in textile workers and kept Berkshire's mills running for years despite Munger's warnings. He trusted management teams that disappointed him. He saw potential where there was only decline. His optimism made him bold, but it also made him blind. Think of his investment in US Airways in the late 1980s through preferred shares. Buffett saw a turnaround story. He believed management could fix it. He was optimistic about the airline industry. It was a disaster. Airlines, as Munger kept warning, were terrible businesses with no pricing power and constant capital needs. But Buffett's optimism had made him deaf to the structural problems. Or consider Dexter Shoe Company. Buffett loved the business, trusted the management, paid with Berkshire stock, his most valuable currency. The business collapsed within years. That mistake cost Berkshire over $3 billion. Paying with Berkshire stock turned a mistake into a compounding loss. The pattern was clear. When Buffett believed in something, his optimism overwhelmed his analysis. He stopped asking hard questions. He stopped imagining failure. This is the trap of optimism. It makes you brave enough to win big, but it also makes you blind enough to lose big. Buffett needed someone who didn't share his optimism, someone who would destroy his favorite ideas before they destroyed his capital. He needed a pessimist. Optimism builds empires, but without skepticism to balance it, optimism builds disasters. Charlie Munger wakes up every morning asking, what could go wrong? Not because he's negative, but because skepticism is the greatest protection against self-deception. Munger's mind works differently than Buffett's. Where Buffett sees possibility, Munger sees probability. Where Buffett trusts, Munger verifies. Where Buffett believes, Munger questions. Here's why Munger's skepticism works. First, skeptics avoid catastrophic mistakes. They don't invest in businesses they don't understand. They don't trust management that can't explain their strategy simply. They walk away from opportunities that require optimistic assumptions. Second, skeptics see structural flaws that optimists ignore. Munger understood immediately that airlines were terrible businesses, that textiles couldn't compete with cheap labor, that certain industries were fundamentally broken. Third, skepticism forces clarity. When Munger challenges an idea, he destroys weak arguments and strengthens strong ones. What survives his skepticism is genuinely robust. Fourth, skeptics prevent ego-driven decisions. Munger doesn't care about being liked by management. He doesn't care about popular opinions. He cares about truth, even when it's uncomfortable. But, and this is equally critical, skepticism has its own fatal flaw. Skeptics miss opportunities. They see too many risks. They imagine too many disasters. They say no to deals that would have worked. If Munger had invested alone, he would have missed many of Berkshire's greatest investments. His skepticism would have protected him from mistakes. But it would have also prevented him from acting on obvious opportunities. Munger admits this openly. He once said, "I'm a skeptic about most things. If I had been in charge of Berkshire alone, we wouldn't have done nearly as well." Warren's optimism is what made us act. Think of Coca-Cola. Munger was skeptical. The valuation seemed high. The sugar content made the product vulnerable. The competitive threats were real. But Buffett's optimism saw the moat, the brand, the pricing power. And Munger's skepticism tested those assumptions until they were bulletproof. The result? They bought, and it became one of the greatest investments ever. Or consider Apple. Initially, both were skeptical about technology companies. But as Buffett warmed to the idea, Munger asked the hard questions. Is this a consumer brand or a tech company? Will the moat last? Can we understand it? The skepticism made the analysis stronger. The optimism made the bet possible. Skepticism didn't kill the deal. It killed the weak version of the thesis. This is the power of skepticism. It doesn't prevent action, it refines it. Munger's role wasn't to say no to everything. It was to make sure that when they said yes, they were right for the right reasons. Skepticism alone paralyzes, but balanced with optimism, skepticism becomes precision. Most partnerships fail because of disagreement. Buffett and Munger succeeded because of it. Here's the psychology that makes opposite minds work. First, ego, immunity. Both men have massive egos in their expertise, but zero ego about being wrong. When Munger challenges Buffett, Buffett doesn't defend his pride. He tests his logic. When Buffett pushes back on Munger, Munger doesn't get offended. He strengthens his argument. This is extraordinarily rare. Most people defend their ideas as if they're defending themselves. Buffett and Munger separate ego from analysis. Ego out, incentives in. Argue the incentives, not the person. The result? They can have brutal arguments without damaging the relationship. Second, complementary blind spots. Buffett's blind spot: too much faith in management. Munger's correction: constant skepticism about incentives. Munger's blind spot: too much caution about acting. Buffett's correction: willingness to bet big when logic supports it. They don't have the same blind spots, so when one is blind, the other sees. Third, shared values, different methods. Both want the same outcome: compound capital over decades while avoiding permanent loss. But their approaches are opposite. Buffett seeks opportunities. Munger eliminates traps. Same destination, different paths. And the tension between paths creates optimal route. Fourth, mutual respect for expertise. Buffett is better at understanding businesses. Munger is better at understanding systems and incentives. Neither tries to be better than the other at everything. They respect what each brings and defer to each other's strengths. This is what most partnerships lack: the security to admit, "You're better than me at this." Fifth, time-tested trust. 6 decades of arguments, 0 betrayals. When Buffett and Munger disagree, they know it's about ideas, not loyalty. That trust allows them to be brutally honest without destroying the partnership. Most partnerships collapse because disagreement feels like disloyalty. But for Buffett and Munger, disagreement is loyalty. It's caring enough to prevent mistakes. The formula is simple but rare. Shared values plus different methods plus zero ego plus total trust equals perfect partnership. Most people want partners who think like them. Masters want partners who think opposite. Here's the uncomfortable truth that destroys most partnerships. People want to work with those who think like them. It feels easier, less friction, more agreement. But agreement is expensive. It costs you opportunities you miss because no one challenged your caution. It costs you mistakes you make because no one challenged your optimism. Buffett and Munger prove the opposite. The greatest partnerships are built on strategic opposition. Not opposition for its own sake, not conflict as dysfunction, but intentional opposition designed to eliminate blind spots. Here's what most people don't understand about disagreement. Bad disagreement comes from ego. I'm right, you're wrong. Good disagreement comes from curiosity. You see something I don't. Show me. Bad disagreement seeks to win the argument. Good disagreement seeks to find the truth. Bad disagreement damages the relationship. Good disagreement strengthens it. Buffett and Munger mastered good disagreement. They argued constantly. They never fought. The difference? They separated ideas from identity. Attacking an idea wasn't attacking a person. This requires a level of ego security that most people never develop. Because most people can't separate being wrong from being weak. But here's the paradox. The strongest minds welcome being proven wrong, because being wrong and learning is how you become right more often. The weakest minds defend being right even when they're wrong, because their identity depends on never admitting error. Buffett and Munger built billions because they were strong enough to be wrong. Most people stay mediocre because they're too weak to admit it. So ask yourself, do you seek agreement or accuracy? Do you want partners who validate you or challenge you? Do you defend your ideas or test them? Are you secure enough to be proven wrong? Because the greatest achievement in any field comes from opposite minds working together. One provides the vision, the other provides the precision. One provides the courage, the other provides the caution. One provides the optimism to act, the other provides the skepticism to wait. Together, they create something neither could achieve alone. Perfect calibration between boldness and wisdom. That's not compromise. That's complementary excellence. Buffett and Munger didn't build billions in spite of their differences. They built billions because of them. The question isn't whether you need your opposite. You do. The question is whether you're wise enough to listen when your opposite tells you what you don't want to hear. Similarity builds comfort. Opposition builds edge. Choose wisely.